morning. No, good afternoon, good evening. Welcome to Traders Workshop for Tuesday, February 14th. I'm your host, Tom Schneider, CMT with NinjaTrader. We're Traders Workshop, where we bring in our NinjaTrader Ecosystem specialists to help you become better and more informed traders. Before we get into it today, I do want to remind everybody that futures and options trading contains substantial risk and is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose, doesn't extend your lifestyle, or your retirement horizon doesn't change your lifestyle. Also want to remind everybody that past performance is not necessarily indicative of future results. And what we talk about here on this program contains neither trade recommendations nor financial advice, and therefore should only be used for educational purposes. And with that out of the way, it's my pleasure to welcome back the founder of Spot Gamma, Brent Kochuba. How you doing, Brent?
I'm doing really well, Tom. It's great to see you again. Great to be here back with NinjaTrader.
Yeah, great to see you. The first time this year, 2023. Happy to have you back on. I always learn something from you when you come on, because I know the topics we're going to talk about are so kind of up here, right? I call it up here, and you bring it down a little bit, so it's eye to eye. But I can't wait to see what you have to talk about today. How you been doing? How's 2023 treating you so far?
2023 has been amazing. The options volumes continue to just go crazy, and so people's attention, on options has just continued through with the new year, and so that's always we're always really grateful for that, because there's plenty of stuff to talk about, and just the flows in the market are flows that make sense to us. And so we're always just sort of happy that trend continues of more options flow. So that's really helping us out.
That's awesome. So can we, for those of you who are new to Traders Workshop, if this is your first time viewing, thanks for coming. If you're watching on YouTube, you can join us in the chat at ninjatrader.com/events. And if you have any questions for Brent, feel free to drop them in the chat. But for those people who are new to Traders Workshop, or maybe have not seen your appearances back in the 2022, can you just give a little bit of background of how you got into the business and your specialty? Because I think that's what's really fascinating.
Yeah, thank you for that opportunity. So I have a background where I worked 20 years on the sell side, or 15 years on the sell side. So I worked at Bank of America and Credit Suisse. I was also a broker at Wolverine, the options market maker, for a while. And then after about 15 years of that, I went to work at a family office for a portfolio manager who specialized in S&P options trading. And I helped him to basically build some models out in the S&P 500. And from that experience, I learned, or came to see, how the market, that's the S&P 500, reacted to these big areas of open interest in the S&P 500 options market. And so I started to be able to put these pieces together of, hey, look at how the options market seems to be controlling the S&P 500. And the models there sort of served as the foundation for Spot Gamma, which was launched in January of 2020. And back in January of 2020, everything that we did was focused on convincing people that, hey, the options market can move the underlying stock or the index. And, some people would agree with that and would come around to that idea. And fast forward a little to January of 2021, and meme mania hit, and GameStop went up 5,000% or whatever it is. And suddenly everyone was convinced that, the options market was an important, held important influences to stocks. And so, the growth of the options market over the last couple of years has really, I think, transformed people's understanding of how, options hedging flows can move markets. And that is particularly true in the S&P 500, which is, one of the largest futures complexes in the world. And so a lot of what we do on a daily basis is telling people, hey, here's how the options positions are changing. Here's how hedging flows may impact the way that the market is trading. And as a result, we have subscribers and members of all types, from options traders at banks to hedge funds to professional, S&P 500 E-mini day traders, right? Anyone who cares about how the S&P 500 is moving in particular, it's kind of one of our core client bases.
So it extends into the stock market, right? I mean, it's not just futures; it's also the spiders, as we call them, the ETFs. Yep. So it's really great for you, right? It's a multi-asset class business, if you will.
Yeah, it definitely is the individual stocks. The way that the options market seems to impact these different stocks versus indices is a little more nuanced. How the S&P is driven by options versus the equities. Like a Carvana or a GameStop or something like that. But what's also happened in the options market is that more of the flow has transitioned to shorter dated options, and so the effects are adjusting slightly as well in the S&P 500 versus underlying stocks. And so as the volatility market shifts around, how high or low is the VIX, and are people hedging for the CPI, or are they not hedging for the CPI, and they're worried about upside after these events, or downside? All of these effects impacts options prices, which impacts options hedgings. And as those hedging flows come in, it pushes around the different assets in different ways, or different equities in different ways.
So you mentioned that you started Spot Gamma 3 years ago. Really interesting time. I'm sure it was for you. But it must have been a little bit of a scary time too, right before COVID hit, right?
Yeah.
And curious to know, just if you can think back. I mean, it seems like a lifetime ago almost, but if you can think back to maybe end of January, beginning of February, did you think something was up, and was that evidencing itself in the options market, as far as the rumors of something happening, and options market making kind of making a bet, if you will, or taking positions against the market continuing to rally, because we were at I think all-time highs right
All-time
before that.
highs, yeah. Yeah. And that was a funny time period, because there was a lot of people were looking at what was happening in China with, unfortunately, people passing away in the streets. And it was just this very kind of gruesome and uncomfortable scene there. And it was clear the pandemic was spreading, and the US market did not seem to care. And what's so interesting is that we went into this February OPEX, February of 2020. There was a ton of call positions in the S&P 500. And on the third Friday of February, all those call options expired. And it seemed like over that weekend is when the sell-off really started. And the speed of the sell-off was so large, and just cascaded in March all the way down to March options expiration. That's the third Friday of March. And the day after that expiration, where just billions of dollars of puts expired, was the market low of 2020. And, some people say, well, yes, a lot of hedging came in, but for example, there was a big Wall Street Journal article at the end of at the end of 2019, that talked about how Bridgewater was adding, huge put positions, right, as part of a quarterly hedge, and those positions were tied to March. So there were these bigger entities that had already positioned some hedges right for a quarterly expiration. But the sort of, we view that the expiration of those big calls in February is what really loosened the market up, and allowed for some of that downside flow to pick up. And it's always one of those interesting things, because sometimes a big headline will come out and the market doesn't seem to care, the market doesn't seem to move, right? And other times a seemingly innocuous headline seems to make the market jump quite a bit. And so you had all these bad headlines in February of 2020. And again, the market wasn't doing much. And then all of a sudden over that weekend, I forget exactly what the headline was, but that kind of caused futures to gap down a little bit on that last week of February. And then all of a sudden, all of those put positions that were in March just popped in value. Volatility shoots higher, like the VIX started spiking, which further increases the value of put options. And all that means that hedging flows have to come in. Options hedging flows have to come in. That's short selling, because that exposure, that downside exposure, is very large for options dealers. And what that does is it creates a feedback loop, right? As the market goes lower, volatility goes higher, put values increase, right? And as put values increase, we need to add more hedging flows. So we sell more hedges, which pushes the market lower, pushes volatility higher, which makes puts values expand, which means you got to sell more, right? So sell more hedges. So there are these feedback mechanisms that come into play. And those feedback mechanisms in a lot of ways sped up now because of zero DTE and the rise of short dated options trading. But you can still see these kind of cyclical flows come in. And what's interesting as we sit here now is there's an options expiration in 2 days, on Friday, which has a fair amount of call positions. It's not a huge options expiration, but there's a VIX expiration tomorrow. And so this is kind of like one of those cycles is ending. We've had a lot of bullish movement up into this price area, 4,100-ish. And again, I think the options that are expiring are going to release us from this general 4,100, price area now, and we'll likely shift to a new point of equilibrium, so to speak, as we head into March.
And you mentioned the feedback loop, right? It's almost like a snowball effect where the further the market goes down, the more valuable the puts, the volatility increases. Is it delta hedging or gamma hedging at that point?
It's really a combination of both. Yeah. So
right.
what happens is dealers have on existing options positions, right? And what you have to assume is by the close of trading every single day, they're fully hedged, right? You're not going to have any material risk on your book at 4 p.m., right before the bell. So your delta is effectively zero, right? And then the next day as the market opens, well, the S&P price changes and things shift around and you have to adjust your risk there. And that's the gamma hedging component, right? I was fully hedged last night. S&P went up one. Was my gamma there? That's how much I need to hedge. And then where the delta component comes back in is that there's obviously continuously new trades coming into the market, right? Someone new comes in today, buys a bunch of puts or sells a bunch of calls or whatever it is. And that can lead to some delta hedging of those individual positions. So there's kind of this mix of hedging flows that come in. And then when you get a big options expiration, like on Friday with the monthly expiration, a lot of options are going to expire, and that can invoke or lead to a lot of hedge adjustments, and that can have a lot of impact in the way the market is moving. There's a great statistic out there. I don't have it queued up here, but the performance of the S&P into the monthly expiration in 2022 is dismal. It's like, I think on average, it's -2.5% or -3%. Going into the third Friday expiration in 2022, and it's something like +2% the week after that third Friday expiration. So you can see that these hedging flows, right, are hedging puts all year in 2022. Those puts expire, and the hedging flows are like, okay, we don't need to be so short anymore because all these puts expired. So let's buy futures back or buy our hedges back, and that can cause the market to rally.
And we could see that rally, or, in that case, these rallies, not necessarily on options expiration, but the following trading day, right?
Yeah, so typically you see them come in on the Monday after, and there's a bunch of theories around this as to, why does the exposure seem to really matter after? I mean, one of the interesting points to bring this up, we talked about March of 2020 low was the day after options expiration. You could look in December of 2018, we had a really big crash, right? And the Monday after was the low. Excuse me. And one of the interesting things to note too is the VIX high from last year, the intraday high, was the day after the January 2020 expiration. If you remember, there was such a violent sell-off in January of 2020, and that was because there were so many huge call positions that were expiring. As you know, there's a lot of people like Nancy Pelosi made this famous, but she buys leaps, right? She buys long-dated call options as the way to get exposure to the market. And so in the situation where in 2020 we had an incredible market rally, the call values for January of 2021, because the market had rallied so much in 2020, the call values that were tied to January of 2022 were just massive. And so when all those positions expire, hedging flows get unwound. And again, the low of the market, the interim low in January of 2022 is the Monday after a big Jan OPEX. But that also corresponded with the VIX high, intraday high. And the reason I bring that up is because, after that January expiration, we had, the fastest rate of rate hikes, I think, in history, right? In consecutive rate hikes. We had the escalation of the geopolitical situation, how unfortunate that is. We had all of the commodity issues, right? Like nickel went limit up and funds were blown up left and right. I mean, there were all these issues, the sovereign debt crisis in the UK, right? All of these things happened last year, but we never exceeded that January VIX intraday high, which was, to me, was so interesting because I think it talks about the impact of some of these hedging flows and how those can really drive volatility or drive movement in the market.
It's almost like the level of those calls, the level of the activity in the options market is at a higher level, no pun intended, but a higher magnitude, if you will, than these individual pieces that might influence the market. But there's a bigger hand, so to speak, in charge here.
Yeah, and I think a lot of that is the growth of the options market. We just had record call options, I think once or twice last week, or kind of the first week of February rather. And so the options volumes continue to grow. And so in theory, then the hedging flows should increase as well. And also, as stock volumes, while they're stable, they're not increasing at the same level, order of magnitude really as the options flow. So that to me says that the impact of the options market is gaining. And the other thing that's interesting about it is that as the options market gets larger, as people hedge, right, that impacts the way that the market moves. And so one of the things we talk about is like with the CPI, and if people are expecting a 5% CPI, move range out of CPI, and that's how the options are pricing it, it's very hard to realize that 5% move, right? Because everyone's expecting it. And so you have to get an increasingly larger surprise out of the data print to sort of actually get volatility, if that makes sense. So if you think about like December, for example, it was about a 1.5% move was the expectation on today's CPI print, whereas back in December there was a 3% movement being priced in. And we had that giant gap up in the December CPI that was back on 12/12. So I guess it's technically November CPI print. But what happens is then if the options are pricing a 3% move and we get an initial pop in prices, okay, we get a 1% pop in the market. Well, suddenly all of my options are too expensive, right? Because my options were basing on a 3% move, but we only got a 1% move. And so what happens is volatility starts to get sold, right? Volatility gets sold off and it ends up really constricting movement. So well, my point here is that the expectations of options traders and the value of the options is actually starting to control the way that the market moves, I guess. There's this kind of axiom that a well-hedged market doesn't sell off, right? And I think that's very true. If you look at last year, why didn't the VIX move higher? A lot of the narrative around that was like, look, people sold their stocks and they didn't have to hedge anymore, right? They didn't have to buy put options to hedge their portfolio because they sold all of their stocks off. And that's interesting in the light of the fact that the VIX never made a new high, again, despite all of these what you may call worsening conditions, I guess, right? With the geopolitical situation and commodities going crazy and all that. No one wanted to hedge. And so the volatility component is just reduced, right? Because there's not that feedback loop of dealers needing to hedge as the market goes down. And so again, it sort of speaks to this idea that one of the bigger drivers of market imbalances are these hedging flows. And it makes you wonder too, like, would the October 1987 crash maybe wouldn't have really happened in the same order of magnitude if it wasn't for portfolio insurance, which is essentially, options in a way, right? So, same thing with like the long-term capital management, crisis in the 90s is like these guys were imbalanced. They were way off sides, and the hedging flows and sort of the unwind of all those positions is what really drives volatility, in a way. It's this imbalance. And I think that options market can bring this imbalance where there's forced hedging in the same way that like a long-term capital management got a margin call, right? Well, margin call and forced hedging is sort of similar. Like they may be different levels of stress, but still, like if I have to short 1,000 futures right now because people just bought put options, well, the market's going to go down because of that, right? It's going to drive the short-term movements of the market.
So, talking about CPI, we had a print today, like you mentioned. Could it be you said back in December the market's priced in maybe a 3% move off of the December 12th CPI? That's what they were expecting, and about 1.5% for today's print. Do you think that's because we're a little bit farther along with understanding where inflation should be and how the Fed's been handling it, and they're telling us all the nice things, right? That we have the tools to manage it, and it looks like it's coming back under control and all these great things. Is this a result of certainty in the market?
Yeah, I think that is correct. And what's interesting to me about that is, when we looked at the price of the S&P 500 over, the last 3 months, the market really hasn't gone anywhere. And I can bring a chart of that up here, shortly. The market, as you can see on my screen here, if I could bring this up, sorry, everybody. The December CPI print was, right in here, and I can make this a little clearer for everybody. But this was that December CPI print, right, on the 12th. And there was so much volatility assigned with that. And then we had the FOMC the next day, and Powell was a little hawkish, right? And that really cratered the market down. But this is where the CPI was. This is where we were for that CPI print. The futures gapped higher, and we're right there right now. Now we've had two CPIs, we've had two FOMCs. The market really hasn't gone anywhere, which to me is kind of fascinating because, I think that there is this element of understanding that the Fed may be getting closer to the rate of rate increases is surely likely to decline, right? I don't think we're not going to get 75 basis point hikes anymore. But now it starts to become a projection of, well, are we going to have a recession or not? Is inflation really coming down? Should we believe what the Fed is saying? All these other different narratives. And so, what's fascinating to me about this is like, yes, before 2022, no one ever cared about the CPI print, right? No one ever cared about a jobless print, at least the options market. It just didn't matter. We didn't have this focus and attention, right? It wasn't like, the CPI print today is like just as big as an FOMC reading of past years, right? Or a FOMC decision. And so what the point is, I guess, is that we're paying so much attention to these data prints, but the market's not really going anywhere, right? And so what's starting to happen, I think, is that the volatility expectations around these prints is coming down. And part of that, I think, is because, we had these data prints that were many standard deviations higher than what people expected. And so traders were kind of caught off guard. And there's echoes of that in hedging, right? If you remember, hey, I got burned 6 months ago on the CPI, I got to make sure I'm well hedged for this one, right? And as these prints maybe don't have much volatility to them, or they come more in line with expectations, then I think the attention to them will start to dry up a little bit. But again, with so much attention focused on these things, to say, hey, look, we haven't gone anywhere ultimately in 2 months. It's quite an interesting observation. I think that the market ultimately is not doing a whole lot. So how much do these prints matter? I think we all have to take this wait and see approach around what inflation is going to do over the longer term. What are the economic impacts, or what is a recession going to come, right? There's all these different factors that are coming in, and today's data point arguably doesn't really help us determine or figure out, what that future path is going to be.
Yeah, I completely agree. I think the discussion has changed, right, as into how much and how long, I think, is the new one, right? Or how long are we going to have these rates, the terminal rate, before we start cutting? Markets pricing in end of the year. I think the Fed speakers are saying, no, it's going to be 2024 before we start cutting. Okay, a little bit of a discrepancy there. And then the recession, we were talking about, are we in a recession back in the summer because we had 2 quarters of negative GDP. And then, of course, we heard all the counter arguments, but the labor market is still strong, et cetera, et cetera. I think that recession question I heard certainly over the weekend when I was listening to different speakers on the radio that I listen to, financial radio. Mm-hmm. And the question, it wasn't about so much yes or no, it was about when and how hard, right? And so, it's interesting times, and I'm curious to know, speaking of recessions, is that something, because we haven't had so many of them, right? It's not an annual occurrence, thank God. But is that something that you can look at the options market and you can say, you know what, I think the options are pricing in a recession, or like you said, no, they're not really care about, they don't really change much with the CPI print or these job numbers or et cetera.
Yeah, you bring up an interesting topic here, because we can't tell, there's nothing obvious in the options market that's going to say, hey, people are pricing in a recession, or they're worried about, an escalation in the geopolitical situation, right? But what you can tell is people are hedging. So one of the things that has not really happened over the course of the year is that there has not been a demand for downside hedges. And I think a lot of that was, again, because people decided to degross or remove positions rather than hedge them, right? So like if I don't own, if my equity position dropped by 50 or 75%, I don't have anything to hedge anymore. And so, what has happened, or what we can see, is that people aren't concerned about downside regardless of what that risk is. And to this point, we didn't see people really, or we don't see people building call positions with the S&P up and around this level, right? There's not this sign that people are looking for another 5 to 10% upside in the market from here. And so, what I sort of look at is say, hey, look, how are people hedging? The hedge funds have, incredible resources. If you think about the options positioning as a voting machine, so the smartest people in the world, if they think that the market's going to go up, they're going to buy call options, right? You're going to see big call positions in the market, and we've seen spurts of that. Are people going to start hedging downside, right? Everyone's talking about Carl Icahn buying these 40, 50 puts that expire on Friday, right? Why is he hedging? What's going on with him? And so I guess what I'm trying to say here is that positioning in a way is the truth, right? If you're worried that we're not going to hit a recession, that the Fed is actually going to take his foot off the rate, accelerator, the interest rate accelerator, then you're going to want to buy calls, right? You're going to want to position yourself probably for more upside in the market. And we don't see that right now, right? If anything, we see a little bit more of a bid to downside. There was a lot of big VIX call positions that were bought last week, and we've seen some elements of skew or measurements of skew and the like starting to pick up a little bit, suggesting that what people are doing here, if anything, are trying to hedge some downside as opposed to the call position. So, I don't know whether there's going to be a recession. I don't know how the market may react necessarily to the CPI, or I don't know what the print would be, I should say. But based on the positions of the market, I can start to get a good sentiment indicator almost for how people are positioned or what their view is.
And to be clear, when we talk about a VIX call position, that's really like an S&P put position in the sense that the VIX is adversely correlated to the S&P. So if you're thinking that the VIX is increasing, you're thinking that the market itself is most likely going to decrease.
Yeah, that's exactly right. S&P puts and VIX index calls are, for the purpose of our conversation, the same thing. You're betting on the market, dropping rather sharply. And so, the fact that some of these bigger positions have come in, I think are a function of two things. One, we've had a very strong rally in the market. And then the second one is that obviously that, or less obviously, that I think a lot of stocks were bought, in January. I mean, clearly many stocks are up, some of them are up as much as 50%. I think the NASDAQ is up 20%. And so now that people have regrossed or added, funds have added bigger positions on the equity space, they may now have demand for hedging, right? So, we talked before about how everyone degrossed in 2022. So I don't need to buy VIX calls or S&P puts if I don't have an equity position on anymore. But now that I've bought back into equities, do I actually have something to hedge? And if that is the case, if there is hedging demand in material size, then volatility could start to move higher, right? The market may have faster episodes of downside. One of the things that was interesting again last year was that even though the market continued to move lower, vol and VIX didn't really move higher, right? The correlation in some ways seemed to break down. And again, was that just a function of demand? If people don't have anything to hedge, then maybe the VIX moves are more muted or volatility is a little bit more muted.
So can we take a look at the chart of, I guess, the S&P maybe, or what I see when I look at the S&P is I see we're starting to make higher lows, higher highs in terms of swings.
Yep.
Right. So 2022, we know the story. It was a down year all year, pretty much. We had lower swing highs, lower swing lows. And now we're starting to see maybe the October lows are what they are. And now we start seeing, I think, higher swing highs, higher swing lows. Do these correspond to any levels that you might see in the options market where you see big positions, whether they're call or put positions at those levels?
Yeah, there's a humongous position at the 4,000 strike in the S&P 500. And so that is going to be kind of a base of operations, I think, that, we'll continuously kind of come back to as we move around. And in the bulk of those positions, or a lot of them won't expire till March, a good chunk expires. But back to sort of this point about are people building call positions above? On this chart here, what we've done is we plot out the size by gamma, right, of the positions at various strikes. And this is across all expirations. So this you can think of as call gamma, or essentially a weighted average of how big the call position is, and then puts are on the bottom. And so, before I was talking about there not being very many big positions above, you can see that the interest above really 4,200, which is right here, starts to really dwindle as the market moves higher. And so what sort of my argument here is that, look, if everyone is really concerned about a massive push to the upside in the S&P 500, you would see these call bars increasing as positions are building, and we're really not getting that. And the same thing for the spiders, and you don't want to ignore the spiders if you're looking at the options market, because there's such big positions there. It's the same thing. This is 420, and then you can see that the positions really start to dwindle. And again, this is a gamma-based metric, but the point here is that what are options traders expecting in terms of future prices? If everyone thinks the market's about to go up 10%, well, then you're going to see these call positions really gain in size, and that's not something we're seeing. So to the downside here, you have this 4,000 level, and you can see how big that is, or how prominent it is on your chart. This is 4,100, which is a very important level into OPEX on Friday. And then again, here in the S&P SPX big contracts, you can see this 4,000 level, and this 4,000 level is the largest options position almost always in 2022, and it's probably going to be, I think, a big level again in 2023. And then conversely, like, how do you look at the downside, right? Well, if these are put gamma positions, if these are an expression of how big puts are to the downside, there's an argument to be made that there really aren't very large hedges to the downside currently in the market. And so if suddenly risk increases for some reason, and people want to demand hedges, well, those hedges, as people put those hedges on, it could really impact the market here, because of the fact that you can make this argument maybe that the market is somewhat underhedged. One of the things that we were looking at was the SKEWDEX, or VVIX increasing the last few days, was something that was gaining a lot of attention. And yes, VVIX has increased, but this is essentially measuring is, in a way, VIX call demand, right? And you can see here that over this year, there's been a small spike, and people are talking about this, but relatively the demand for hedges, which is what this is reflecting, is just not really increasing, right? There really ultimately is not much fear in the market. And if something does strike the fear into the market, well, there could be a pretty nasty downside to that, right? Because if there are no hedges and everyone needs to move into hedges, then that could really propel the market lower.
So going back to the chart where you showed the S&P positions at the 4,000 mark, to me, that's like a North Star almost, because the price, according to this, there's not a trend. There's not a clear trend where it's increasing from 4,000 or decreasing in a trendy way, right? It just kind of the positions outside of 4,000. There's nothing really saying this is where we're going to go, because if it did, we would see increasing volume possibly on the right, or on the top level in the call side, or in the put side on the bottom. So is this just indicative of maybe a market that trades sideways for a while? Yeah,
this is exactly what I think. And I think that, for some reason, I always have this idea of the lost decade pop into my mind. And you bring up a really great point, because, pre-2019, we were all used to this idea that the market actually doesn't have to go up, or it doesn't really have to go down, right? But into the stimulus era of March of 2020 and 2021, we're all trained that the market should go up, 20% a year, and the Fed should come out and stimulate everything, and that should generate, these large, massive trends in the market. And so, kind of exactly to your point, if we look at the chart again, what if we just sort of don't do much? And this kind of cycles back to this idea after the CPI in December. Well, we haven't really done anything from that. So you could make this argument that what's going to happen here is more of a stock pickers market, right? Different sectors are going to perform very well versus, other sectors. So you want to buy maybe value versus tech. And, if you look at, for example, the S&P value index, that's at an all-time high, or right off those all-time highs. These are the stocks that, in 2020, nobody really wanted to own, right? But, if you look at the NASDAQ, obviously that's hurting quite a bit. And so this idea that people are going to have to pick stocks, the trend is a little more difficult to pick out, or the S&P may just stick around this 4,000 level for the year, I think is a very valid one. And how many people, when they kind of ask the banks, what's the S&P going to do this year? I don't think anyone marked zero, right? 0% return for the year. And that could be that is a very valid, argument to be made there. I mean, if you look at 4,000 on the chart here, you can see that we've really just revolved around that area since essentially, May, right? So you bring up a really interesting point, and maybe we should all, consider selling the 4,000 straddle for December and then just go on vacation. Not investment advice, by the way.
Right, of course, not investment, past performance, not indicative of future results. But you're right. I mean, people, is the market going to be up or down in 2023? We want to know, is the market at the end of the year going to be greater or less? We had a strong January. That a lot of times that indicates that we're going to have a positive year, but a positive year could stick at that end of January, right, and just go sideways, which over time that doesn't help our portfolio too much, right? It depends on our positions and all that. But everybody wants to say, oh, we're going to make new lows. Oh, we're going to, we're still in a bear. No, we're breaking out of the bear. We're in a bull market, or this is a bullish trend. Okay, yeah, there are cases to be made, but it's all about your length, right? A length of time, your term, if you will.
That's exactly right. Yeah.
Yeah.
And even on an intraday basis here, I bring up the daily chart because, here's the reaction to the CPI, and we hit 4150, right? And then we reject down to 4100, and now we just bounce, right? So we've just been in this range all day. It's a large range of 1%, but ultimately, we don't really seem to go anywhere. And this sort of segues slightly to the 0 DTE options impact. And I'm doing a lot of studies on this right now. And I think a lot of people think that 0 DT is this smoking gun that maybe, creates volatility, at least in the indexes. But my data in my initial study here show that what 0 DT seems to do is actually constrict the market. It seems to actually put guardrails on the market on a daily basis. And this is on the S&P specifically. I think in single stocks, it could be a little bit different, particularly in the small cap stocks like a Carvana or something like that. But so it's sort of funny, like on a short-term basis, it's almost like we start to break out and the market will just snap, right? Like here, there's this big breakout in the morning and then we just sell off. Well, why did we sell off? Everyone's looking for a reason. And if you actually start to look at the options market, it starts to explain some of these, bigger intraday swings, and the big intraday swings feel like there's a lot of volatility. But then when you zoom out, right, to that chart we just showed, well, we actually don't really go very far over time. So if I just give you an idea of those 0 DTE flows, which you have on your screen here, and I'll actually just mute the, all I'm showing on the screen here in white is the S&P 500, right? And then in green is 0 DTE options flow. So that's just the calls and puts that are bought for today's expiration. And you can see these very clear trends that come out. And I'll explain these to you here, but it just sort of magnifies what happens. In green is calls, right? And in blue is puts. So as the market rallies this morning, people are buying calls off the lows. And then all of a sudden at 4150, people start selling calls and buying puts, and the market goes down to 4100, which is the big support level. Then they do the opposite. They sell those puts that they bought up here, right? And they buy the calls that they shorted up here. And it's just this cycle that seems to rinse and repeat. I mean, you can see, to explain this a little bit further, if these lines are going up, right, the green and blue, that's telling us that there's positive delta trades in the market, which means that dealers may have to buy hedges to hedge themselves. And so again, what you're getting here is the evidence that the options market is just controlling intraday swings. So if you look at this from calls and puts combined, as the green line goes down, dealers have to sell futures to hedge 0 DT flow, right? The market comes down as well. As we hit big support, all those options get bought back, or positive delta flow comes in the market and the market bounces, right? And you can see the correlations here come in so strongly. And so it's almost like this idea that the market on an intraday basis has some sort of semblance of free will. And I don't know that that's really true, right? It's almost like the options market's not going to, like if Powell is going to cut rates and the market's ultimately going to go to 5,000, well, that's going to happen, right? But the day-to-day movement, or how much it shifts on a day-to-day basis, seems to me to be very under the control of how the options market is dictating things.
So you mentioned 0 DTE. We have something similar that was just rolled out, I would say, in the last 3 months, called event contracts. Are you familiar with event contracts?
A bit, yeah. Mm-hmm.
Yeah. So, some people call them a 0 DTE option. The contract opens up at the beginning of the session and then they expire at the regular trading hours end. This would be interesting to see how this kind of information can help guide the event contracts. Now, I don't have my event contracts screen up, but it's very interesting. They just introduced last week. They just introduced more frequent strikes for those event contracts around the trading. So I can see where this would be very useful to see. Okay, well, where are those levels likely to return to, or are we getting away from an important level? Are we trending towards an important level? And of course, by important level, I mean something like that 4,000 level that has so much activity.
And this is 410 spiders right here, is the biggest bar in the spiders. And that will be affected into Friday. But also to your point about the event contracts, this is a snapshot of the SPX volume, 0DT volume. This is from 12 o'clock before we started the show. But what you can see is that, there's 20,000 calls up at the 4150, and then there's even more up at the 4200. So as the market spikes right on the open, it seems like everyone came in and just shorted these 4200 calls, right? And then as we move down, you can see the big put positions or big put concentration at 4100. So what happens is there's no position at the start of the day in these 0DT contracts, but then the contracts is where all of the focus of the volume is, right? So the guardrails build up throughout the day and start to dictate things, right? So there's a lot of fluidity in the first half of the day, and then as these big guardrails kind of increase in size, and you can see them here, the market seems to kind of respect those levels. I mean, you can see very clearly here, right, the 4100 to 4150 area. And then when you put that together with the chart that we were looking at before of actually how the flow is coming in, you can really clearly see how these short dated contracts, like what you just mentioned, are having a lot of intraday influence.
And it's almost like you're loading the evidence in your favor when you see these levels, right? The probability of getting outside these guardrails, so to speak, are lesser because the market doesn't want it there. The market has made their delineation, so to speak.
That's right. And what's the other thing that's interesting about this is that, even if you don't want, if you're not an options trader at all, if you just focus on trading the E-minis or spiders or whatever it may be, this information should matter to you, in my opinion, because of the fact that there's so much options flow, and the options flow is going to be hedged right around these key areas. And so even if we possibly break 4,100 because one big order came in and pushed us lower, you can make an argument that the options flow is going to push us back to 4,100, even if kind of like some initial early flow gets the jump, right? Because you can think of these areas as magnets, where if things get imbalanced, right, over the short term, well, the longer term, bigger flows, right, are going to push us back to these strikes that have so much open interest so much volume associated with them. So you can really see these flows kind of come in. So, I can make the argument that if you were short at 4150, and obviously these are big round numbers, so they make sense. But if you're short at 4150, if all this volume is trading at 4100, how much lower do you think the market's going to go on a single day basis, right? So where these big options flows are coming in can maybe help you determine, how much of a swing are you looking for? How many points are you trying to get out of your trade, for example? How much volatility should you expect? If you know where these big options levels are coming in, and they're not always on the round strikes like 4150 or 4100, sometimes they show up in strange areas like you can see here, or to the downside, there's a lot of volume. And I'm sure this has picked up dramatically over the last 45 minutes. Where these positions are really fill in, and again, you get like bowling. It's like the guardrails, increase, and the ball has to stay inside of those, inside of that lane.
Right, and it could help you with your stops as well, right? So if you want to stay in a trade, right, and that 4100, 4150, you're short, but 4150, if we start trading near there, well, maybe I go above it a little bit because I want to stay in there. I know it's going to stop there. I think it will. But yeah, it can help you with targets. It can help you with stops. That's just great information.
Yeah, and again, if the future is going to move overnight, they're going to do what they're going to do, and the 0DT position when we start the day is almost non-existent, right? On a daily basis, the positions are extremely small, and so it's whatever the price action is on the morning that really starts this starts the flow, right? And then you'll see the positions fill in. So you can actually early in the morning start to see, okay, calls are coming in at 4150 and 4200. So that may be kind of where the market's going to top out in that area, right? Because the call flow is coming in. So you can watch these levels build, right? You can watch these positions just increase as the day progresses. And so it's fascinating from that perspective, because again, it's not like this flow is controlling where we go tomorrow, but it controls how the session unfolds, if that makes sense.
No, that's great. Brent, as always, it's way too soon. We're up against time. So
Yeah, it goes fast.
I've got so many more things to, ask you about. It's great stuff, but where can people find you if they want to continue the conversation?
Thanks very much for that. I'm at spotgamma.com. We write a 2x. No, I'm sorry. I made a mistake here, everybody, of unsharing my screen very quickly. So I blew up the end of the show here.
Oh, we're good. We're good. We're back.
All right. I'm at spotgamma.com. We write a daily note. You can find me at spotgamma on Twitter. And then we offer a bunch of intraday options analysis tools and different things like that. And so we also, most importantly, pump our daily levels out to NinjaTrader. And so if you have the NinjaTrader platform, you just hook to one of our CSV files, and every morning you get the fresh biggest options levels just dynamically loading into your NinjaTrader platform. And so you can get a free 7-day trial of that at spotgamma.com.
Brent, thank you so much. And thanks for all of that. And always great to see you and have you back on here. We'll do this again real soon, I hope.
Yeah, I'd love to be back. Thanks so much, Tom.
Yeah, my pleasure. And thanks to all of you viewers. We will see you. Jim Cagnina will be back on for bars closing today. Thanks for coming. Thanks for participating. And in the meantime, have a great trading day.